Have you ever wondered how the economy is really controlled behind the scenes? Why the stock market suddenly booms or crashes seemingly out of nowhere? The answer often lies in two powerful tools used by central banks: quantitative easing and quantitative tightening. In this video, we're diving deep into the heart of modern monetary policy. We'll unpack how central banks use quantitative easing to pump money into the economy, and how they use quantitative tightening to pull it back out. You'll learn how these tools affect everything from inflation and interest rates to your job, your mortgage, and your retirement savings. Let's begin with the basics. What is monetary policy? To understand quantitative easing and quantitative tightening, you need to understand monetary policy. This is the process by which a central bank like the U.S. Federal Reserve controls the supply of money and interest rates to guide economic growth and inflation. There are two main types of monetary policy: conventional, which includes adjusting interest rates; unconventional, which includes tools like quantitative easing and quantitative tightening. When conventional policy isn't enough, for example during a recession or a financial crisis, central banks turn to unconventional methods. That's where quantitative easing and quantitative tightening come in. Quantitative easing was born out of crisis. After the 2008 global financial crisis, central banks needed to act fast. Lowering interest rates to near zero wasn't enough. So the Federal Reserve created money not physically, but digitally, and used it to buy financial assets. This was quantitative easing. It had one main goal: stimulate the economy by injecting liquidity into the financial system. The Fed started buying treasury bonds and mortgage-backed securities from banks. When the Fed buys assets, it credits the seller's reserve account. This increases the amount of money in the banking system, lowers long-term interest rates, and encourages lending and investment. Between 2008 and 2014, the Fed launched multiple rounds of quantitative easing, adding over $4 trillion to its balance sheet. So how does quantitative easing work in the real world? Lower interest rates. By buying long-term bonds, the Fed reduces their yields. Lower yields mean lower interest rates on mortgages, car loans, and business borrowing. Wealth effect. Lower rates make stocks more attractive. Asset prices rise, making people feel wealthier, which increases spending. Currency devaluation. QE can weaken the national currency, making exports more competitive. Bank lending. Quantitative easing increases bank reserves, encouraging them to lend more. This can help jumpstart growth. But quantitative easing is not a silver bullet. Critics argue it mainly inflates asset bubbles and widens the wealth gap. Despite its benefits, quantitative easing comes with serious risks. Asset bubbles. With so much cheap money chasing returns, bubbles can form in stocks, real estate, or crypto. Wealth inequality. Quantitative easing raises asset prices, but not wages. Those who own stocks and real estate benefit the most. Distorted markets. Quantitative easing can suppress natural price discovery, and investors begin to rely on central banks to support markets. This is what many call the Fed put: inflation risk. While quantitative easing didn't cause inflation immediately after 2008, the post-COVID quantitative easing combined with fiscal stimulus did contribute to the 2021 to 2022 inflation surge. Quantitative tightening explained. If quantitative easing is the gas pedal, quantitative tightening is the brake. Quantitative tightening is the process of shrinking a central bank's balance sheet. Instead of buying assets, the Fed lets them mature without reinvesting, or outright sells them into the market. The goal? Will excess liquidity out of the system to fight inflation and cool down overheating markets. Quantitative tightening raises long-term interest rates, tightens financial conditions, and slows down borrowing and spending. 2017 to 2019 Fed increased rates, a quantitative tightening attempt. 2022 to 2025. The Fed aggressively raised rates to combat inflation. But quantitative tightening is delicate. Pull too much liquidity too fast, and markets can panic. This happened in September 2019 when the repo market seized up, forcing the Fed to inject emergency liquidity again. Chapter 6. Case Studies. Quantitative easing and quantitative tightening in action. Let's walk through some real-world examples. First example is the 2008 financial crisis. The Fed flooded the market with liquidity in November 2008, purchasing $600 billion in mortgage-backed securities. This helped stabilize banks and brought down mortgage rates. Second example is the 2020 pandemic. In March 2020, the Fed unleashed unlimited quantitative easing. Within months, it added over $3 trillion to its balance sheet. The stock market rebounded rapidly, and asset prices soared. Third example is the 2022 to 2023 inflation crisis. With inflation above 8%, the Fed stopped quantitative easing and started quantitative tightening. It raised rates aggressively and began shrinking its $9 trillion balance sheet. Markets responded with sharp volatility and a bear market. Chapter 7. Global Key and QT Narrative. The US isn't alone. Other central banks use QE and QT too. European Central Bank. Quantitative easing helped prevent Eurozone breakup during the sovereign debt crisis. Bank of Japan. The BOJ has practiced quantitative easing since 2001, even buying stocks through ETFs. Bank of England used quantitative easing during Brexit uncertainty and COVID-19. But global QE raises concerns about currency wars, capital flows, and synchronized bubbles. What does the future hold for quantitative easing and quantitative tightening? Where do we go from here? Some economists argue that quantitative easing is now a permanent feature of modern finance. Others warn that too much reliance on quantitative easing erodes market discipline and inflates systemic risk. There's also a growing debate over quantitative easing for the people, where central banks directly finance government spending or give money to citizens. Meanwhile, quantitative tightening will remain a necessary tool to control inflation, but it's politically and economically painful. The key challenge for central banks is striking the right balance, stimulating the economy without stoking bubbles, and tightening policy without triggering a crisis. Quantitative easing and quantitative tightening are two sides of the same coin, tools of immense power used to steer the economy. Quantitative easing can save economies from collapse. Quantitative tightening can help restore balance. Both come with risks, and neither is perfect. As we move deeper into the 21st century, understanding how these tools work and how they affect your financial life is more important than ever. So make sure you understand them.